The best trait of an investor is questioning and curiosity. Look for the smartest person in the room. Don't be the smartest person in the room.
Do you believe that founders make for better investors overall?
An investor lives in the zone of uncertainty. I don't know. Let me find out. I don't mind being wrong as long as I can make money. If I had to take this call 10, 15 years prior in this environment, I would become an entrepreneur. What is your edge? Why would a founder take your money? That's my number one question. My best IRR is my own investments. And by the way, people think VCs make fees. I have been negative cash flow in this business out of the 17 years, probably for 15 or 16. And it's by design. I want to be negative cash flow.
Hi, I'm Sandeep Jethwani, the co-founder of Deserve and the host of the Create Wealth podcast. Today on the podcast, I have with me Avnish Bajaj, who's one of India's most successful venture capitalists. He was a founder of Baazee and sold it to eBay back in the day for $55 million. In this conversation, Avnish and I talk about his journey as a founder turned successful venture capitalist. How does he make investments into exciting startups? And how has he compounded his personal wealth? Avnish, one of the most interesting things, I was doing some math around this. 2004, and this is what Matrix website says, you exited Baazee for $55 million. I was trying to compound it at 15%. And today that number will be just short of $1 billion.
Yeah.
So in today's value terms, it was almost like a unicorn exit.
Yeah.
And yet, after such a successful exit of its time, you decided to become a venture capitalist. Why did that happen?
If you look at all the top consumer companies in India, the founders actually got diluted down, sadly, to single digits. We were somewhere in that range. But I think it's still a good question. And by the way, my kids remind me that if I had not sold, we would be billionaires. And I tell them that it wouldn't change my life. And they're like, we don't care. It would change our life. But it would not be. It doesn't work like that, right? Would we have given Flipkart a fight? Probably. So it could have been a very different thing, but zero regrets, genuinely. I think for your audience, it may be an interesting story. I have taken the hardest path to the same outcome that people could have taken. You know the business, you compounded it. I have not stayed long enough in things to compound, and that's been my big learning, and which is why I'm going to do this forever, what I'm doing now. So I joined Apple Computer when Apple at one point was worth 600 million, Microsoft, and I don't know, split adjusted, I had once done the math. I had 5,000 shares at the time, which today would be 700,000 or something like that, and you know the value of the stock. Anyway, when I did the math, it was very, very large number.
Sure.
Then I joined Goldman Sachs before it went public. I had a big stock grant. I left as soon as they went public, and that stock went up a lot. So actually, like for like, when I did the math after Baazee exit, I was worth the least than if I had stayed at Apple or stayed at Goldman Sachs, right? But I enjoyed it the most. So I think that kind of is the reason why I'm doing what I'm doing, because money is just an outcome. People generally who are too focused on the outcome, they tend to take shortcuts, which is what I was taking. I did start Baazee in the .com bubble because I thought I could make a lot of money quickly. It was not quick. It was very painful. And money, in my view, is a gap between your means and your wants, and whereas it should be the gap between your means and your needs. And people confuse their wants and their needs. Fortunately, that has never happened with me. I drove the same car for the following 5 years until my wife basically said, wherever we go out, the valet is the last to bring our car. Can you upgrade the car, right? So why did I do this? So at that time, today I know this. Do you know this concept of Ikigai?
Of course.
I didn't know that it was called Ikigai, but I did sit down and I said, how do I think, what framework should I apply? Having done an MBA, I have to have frameworks. You are an MBA. What framework should I apply to the next phase of my life? And I came up with this, and it's a Matrix Moment podcast also, passion, skill set, and opportunity.
And Ikigai is similar. It's about
so
what you're good
Ikigai
at.
about 10 years ago. This is 20 years ago. And it turns out that it's a much better articulation of this, and it says what you love, what you're good at, what you can make money at, and what the world needs, right?
Yeah.
If you work at the intersection of that, then you'll be happy. And my goal was that. So I had three paths. I had already made 15 to 20 angel investments. So I thought, should I do this? I'm really liking it. Founders used to reach out to me. I was not on the board. They used to say, we want you to attend board meetings. So I said, maybe there is something here. So skill set is there. Passion is developing. Opportunity seems early but interesting. Country might need it. Second was to become a education entrepreneur and professor, because I've always wanted to be that. And you will see it through our podcast. So, and then I realized that it was more of a passion project. And I wasn't really excited about the education business. And then I said, I can become a successful businessman and I can go teach wherever I want. So that went out. And third was entrepreneurship. And having been a digital entrepreneur, it was clear to me that the opportunity in 2005-06 was more for a services business, and especially cross-border, than a local India consumer business, which turns out we were right? It was too early. So I said services, I'm passionate about consumer brands. So that's how I came to this answer. And then it was not questioned for maybe 10 years post. And then seeing all the entrepreneurs like you take off, I questioned it again, saying, is it time for me to go back into entrepreneurship? And maybe we can come to that later.
And how did Matrix itself happen? Matrix by this time, I suspect, was a investor out of the US. How did the India office get
So
started?
2006 was a time where there was serious FOMO about India. So Sequoia, Matrix, Nexus, Helion, Elevation, which was SEF, everybody was set up at that time. DFJ, Tiger, Summit. So I partnered with Rishi, who was coming out of Sequoia, what became Sequoia, and we were going to launch our own fund. And at that time, all these global brands were also looking at India. So we got introduced to the Matrix guys. They have a history which people are not aware of. They were the largest backers of Indian American entrepreneurs in the US.
Oh, okay.
All those entrepreneurs succeeded with their backends in India. So they knew India, they had visited India. So when I told them there's no tech opportunity, they said, we agree. They said, why do you want to do it by yourself? You're going to be competing with these global brands. And obviously, starting out new in a business, the mentorship, all of that was also important. So then I wouldn't say it's an India office. They realized that having been an entrepreneur, the only way this would work would be a loose partnership, right? Loose joint venture. So I think the best way to think about it is they were the third co-founder of the firm, but the firm was always local.
So, Avnish, for somebody who's starting off and becoming a VC, what would you recommend somebody who's starting up? Should you launch your own fund in current context, or should you do what you did back then, which is to under a broader umbrella, because there's the elements of fundraising, there is elements of learnings that existing ecosystems bring, and then there are those systems and processes, etc.
Yeah.
So how would you think about it today?
Is this a person with a lot of experience and background?
Let's say somebody like you today,
Yeah.
who's been an entrepreneur, has a successful exit,
Yeah.
and is becoming a VC today.
I think it's going to be very hard for them to raise money. Because 5 or 6 or 7 firms have established themselves, and the question will be, what is your right to play and what is your right to win? So I would say, forget global platforms and all of that. The question is, do you have a right to play and right to win? Where I think the next set of opportunities will come in being a VC is vertical funds. So if you look at, there are fintech focused funds. Now, over a period of time, like if you look at Ribbit, QED, you would know them well given your sector. They have started off as a vertical focused fund and then diversified. And that vertical focused fund started because of the founder had experience in that.
Sure.
That's the only shot. You look at Together. Together is started by Girish, Manav. They have a right to play and right to win. Why will an
They're in
entrepreneur?
SaaS,
Yeah. And why will an entrepreneur pick a fund? Right. So I think horizontal fund, very difficult. Horizontal fund, the opportunity really is in the Series B mid-market. There's still a gap in India. It's called the 15 to 50 gap. If you want somebody to write a $15 million to $50 million check, that market is still empty. It's us VCs who go up and then you get a syndicated round. Or it used to be the later stage investors coming down, but that was FOMO investing. Now they have also disappeared. So I think horizontal, maybe there's an opportunity there, but it's going to be tough to raise money for that.
And just to explain this point, Avnish, so seed and Series A is when pre-product market fit or around product market fit an investor is investing. And C, D are typically growth rounds where you're funding the growth. The gap you're saying is between A and C, where typically it's like the value of death in some sense from a funding standpoint, because there are no investors focused only on that category.
Correct. And I think the way to overlay is there are 3 stages of a company. There's early PMF, scalable PMF, and scalable profitable PMF.
Sure.
Everybody at different stages takes different risks. We take early PMF, maybe scalable PMF risk between seed and A. The C, D, E, and so on investors are not wanting to take either scalability or profitability risk. If anything, they will take one of those, which will essentially bring their returns down, but they don't want to be taking those risks. They are willing to pay higher There's a very well-known saying in the market that I'll pay more for certainty, right? We are in the uncertainty business.
Sure.
They are in the certainty business. That's a big difference. The value of death is in between. Can you straddle both, right? Can you have some combination of risk and reward going into your thinking? So the gap is in that because of this reason, because that's a very different skill set. It is a little bit of this skill set and is a little bit of that skill set. And it's very hard. That's why people don't do it very well. I mean, tell me one Series B, C big firm in the world. Very few. The ones that have done well have actually tagged themselves onto some successful early stage VCs and just become their follow-on investors, right?
Yeah. So this part I want to explore a little bit later, Avnish, where we talk about like what are the skill sets as an investor you need at different stages of a company's journey. But going back to the original point, right? Do you believe that founders make for better investors overall? Now ignoring the fact that how you raise money, etc. Let's assume that a fund is raised. I'm a ex-founder employed at a fund or a partner at a fund. Would I do better than somebody who's been a professional investor all their life?
So I actually have data on this, but let me ask you, what do you think?
So actually there are two perspectives right here. And I think as a founder, I find value in the fact that the board has a combination of both, right? Advantage of a founder investor is that on ground, it's much more real in terms of the advice that they give. It's not theoretical, it's very real. And sometimes these are very tactical situations that you're dealing with. For example, how to deal with a senior exit in the company, right? That is something that rarely, if ever, a professional investor has dealt with in their lives, right? But for a founder, this is like the way of the world. Like they deal with it all the time. But from a professional investor perspective, the outside in perspective, right? Where how should you look at the company's data? How should you look at narrating your company's story? Some of those things are valuable even there. So personally, I found value in having a combination of these. But now as an investor...
So the data is the opposite. The data is more in line with what you just said. So the data is operators don't make good investors. And I can give you 10 reasons because I've been through that journey. The reason is what you just said, and maybe we can digress into that. The reason is operators live in the zone of I know and I'll make it happen and I'm right. You don't have that much scope for uncertainty because you're a founder, you've got to make it happen. That's the worst recipe for an investor. An investor lives in the zone of uncertainty. I don't know. Let me find out. I don't mind being wrong as long as I can make money. Right? It's a very different mindset. Very different mindset. You said outside in. Founders, by definition, the best founders are somewhat outside in. They will do customer chats, whatever, but ultimately it's very inside out.
Correct.
This is the view and this is what to do. Best investors are always looking for what we call contra data. If you listen to me in the meetings, you will often hear in our investment meetings, these are all knowns. Where is everything sounds like we are backing our own thesis, right? Where is the contra data? So therefore, now, when this analysis was done, it was about 60%, 70% non-founder investors, people like Mike Moritz. He was a journalist. What is the most important trait of a journalist,
Questioning.
which is underlying curiosity.
Correct.
The best trait of an investor is questioning and curiosity, right? And if you ask me, the one thing that I find, because you had asked me in some other context, the one thing I find consistent across the best investors in the world is they are hyper curious, right? So वो founders में कई बार नहीं आता. Although my view is founders also should be that. Otherwise, founders get, if you have listened to some of the podcasts we have done, digital industrialists, infinity founders, I think what differentiates them is what Andy Grove said, only the paranoid survive.
Right.
Always trying to figure out what can go wrong, what is outside. But it has to be balanced with serious conviction and projecting conviction, because you want your teams to succeed. So it's very different character sets. And the latest data, though, is it has moved a little bit more in operator-investor realm. But to me, that's a tautology, because more operator investors have started up. And therefore, by definition, they are taking more share.
Yeah.
But if you were to ask me, it starts off as a big negative unless you are a... Now, that said, Matrix is an operator investor firm. And why are we doing that? Why we have done that is, you are an experienced founder. We are founder backers. And if we are founder backers, and again, it comes down to, are you market backer? What are you picking? If you are founder backers, the founder has to respect you. And in your first round, you are more likely to respect somebody who understands your domain, has more founder empathy than in your later rounds. So our org approach is aligned to our strategic approach.
Yeah. No, makes sense. So Avnish, like today, if you're then hiring a VC, right? Are you naturally looking at people who've been consultants, investment bankers to recruit a VC, because they will probably
Never.
have that
No,
outside?
not anymore. We did Matrix 1.0 is all that.
Yeah.
And they're all senior people, including Vikram, Rajat, everybody, right? Because there was no other pool. Today, are you going to respect somebody who's a consultant, a banker, or will you respect somebody who's built a fintech company before? Maybe they have failed, but they built something. You're more likely to go with the latter. So we are hiring domain. We are hiring domain, and we have become the most domain specialist VC in the country, I'll tell you. I mean, if you look at the last 2 years of team building, it's all domain.
You know, and an interesting thing around that is that we get a lot of inbound for hiring from people who are currently VCs or relatively maybe early in the VC journey.
Yeah.
But they're like, we want to experience this other side. And I always wonder, why are they trying to make that switch? Unless, of course, they don't want to be a VC, but some of these guys still want to be in the future. Looks like they want to get exposure to operating inside of a company. Is that a good approach?
Very good approach. But if we back up, so every Matrix person who tells me they want to become an operator or entrepreneur, I encourage significantly. Just quick digression. See, I'm a big believer over what's going to happen over the next decade. We have discussed this before. I think the market, digital, if you do the GDP and all of that, if India becomes when India becomes 7-8 trillion, digital, we are more digital led, 20 to 30% penetration. There's a trillion to 2 trillion of market cap coming. So I would encourage everybody to be an entrepreneur right now, honestly, if you ask me, including my children and friends and family and all of that. Now, to me, if you have some VC background and you do that, you would have learned great outside-in thinking.
Sure.
And start thinking, what do I not know? I think they can make great operators. That's not the history, by the way. If you look at global data, very, very few. Now, in India, Ashish is the best example of that. He's obviously done it, and he's broken
Ashish Mohapatra
of business, right? Now, the other way around, which is what we were discussing before, I think it's almost a must-have. Like I said, we won't hire people who don't have domain. So there is domain and there is investing, and our goal is people should come in and teach us domain and learn investing, not the other way around. If they are great investors, they shouldn't come to us anyway. They should do their own thing, right? So to me, yes, so when people are coming and joining you, at the end of that exercise, I think they are really well set up to be either a VC or a entrepreneur, right?
And then Matrix or whichever other VC fund would effectively train them around.
No, but if they're already a VC, they're somewhat trained anyway.
Yeah.
This combo, what we have found is when people become operators, rarely do they want to come back because they taste blood. And then the path we have found is they go and become an entrepreneur.
Yeah, so they sort of park themselves at a VC before their next gig, because effectively the kida of trying to do something all over again is very high.
Yeah. And in India, you will start seeing, we haven't had these models so far. I think Kunal Shah of Cred was an EIR with Sequoia for some time.
Sure.
But I think that model will start also, much more. I mean, we are open to it. We have Rahul Chaudhary right now.
Yeah.
Who's
founder Trebo.
Ex-Trebo. He came to the VC side and he said, I want to do something. Right? So.
Yeah, no, in fact, I had this conversation with him at one of these after a couple of drinks, and I was asking him the exact same question.
Yeah.
And he was like, khujli to hai abhi bhi ki I want to do something.
Yeah. And my view is, if I had to take this call 10, 15 years prior in this environment, I would become an entrepreneur.
Yeah.
It is just so, what you can create in terms of legacy when you go deep is different from what you can create in legacy when you go wide, right?
Sure.
This is a width business.
Sure.
So,
though arguably there are VCs who spawned so many companies because of the worldview that they have and the help that they can give to the founder, that their leverage in life is significantly more, right?
Yeah. So on that also some philosophical difference, Sandeep. I don't believe the VCs can really change a founder's destiny. I think the best founders suck it out of the VC. And so I think what those VCs did very well is either pick great founders or pick great markets ahead of the trend.
Sure.
Right?
And on that, and that sort of brings me to my next part, Avnish, which is how, like at Matrix, you'd probably see the best deal flow, I'm assuming. Like any founder who's reasonably got access to you guys would reach out, you'd be able to evaluate. Given that you see such high quality businesses, what is your framework or mental model for figuring out which ones to back?
Yeah. So we do a thesis. Let's say any sector we pick, we say, if we are meeting a company without having a point of view on that subsector, we will not make that investment. And I think many of our peers are very good at it as well. They will just say no thesis is equal to no investment. Now, what does a thesis mean? To your point on trends, all of that, ultimately we are not in the consulting business. So we want, and which is why, by the way, we want more operators, because operators by definition, having come from the domain, know where the skeletons are hidden. That's our job, to know where the skeletons are hidden and know where the reward is that others can't. So it's a risk reward business. VC is a business where you have to almost also imagine the future, right? What can happen, not just what is happening now. So what we do is we form a thesis. The biggest question in our thesis that, again, I will ask and others will ask is, what's the edge in our point of view? Again, reiterating something I said earlier, investing is a business of unknowns. Life is a business of knowns, right? So if you look at a 2x2 and say me, known, unknown, and others, known, unknown, if most of the time people operate in the known box, that's not investing. Where we want to operate is known to me, unknown to others, both in risk and in reward. That's the focus of our thesis.
And that's the opportunity, because if it was known to both, it would probably have been discovered.
It's market, right? So we call that matrix edge box. Now, you have to do a lot of outside in work to get there. But the objective of a thesis, and this is something the founder of Matrix US told me when I asked him what is the best advice you can give me, and which will I'll connect back to your question on what do operators get wrong. You start backing yourself. You start backing your own thesis. So he said, look for the smartest person in the room. Don't be the smartest person in the room. Right? And that's the job of the thesis. Know enough. And by the way, let's take Ola as an example. So we had done a thesis. Tarun, Rajinder, I were driving this whole, Meru was coming up, Savari, like there was a cab company a day. This was 2010-11. We've all lived in Mumbai, the local cab experience is broken. So you first start with saying, is there a pain point, significant pain point. In Mumbai, despite having the black and yellows, in other cities, so there was nothing.
Sure.
Right? So, significant pain point. Is there a technology edge? Unclear. This was 2011-12. Does it need to be fixed? So on and so forth. Now you had, cab companies like Meru coming in where you call. They was doing a pretty good job. We went and did a full scan of that sector. We went and met every company out there. And we reached the conclusion that there is no way to build a large scalable business. And there's a very poor business model which for various reasons, including the fact that in that era, a cab company has zero network effects in going from one city to another city.
Sure.
Then we met Mr. Bhavish and we told him, you have no edge, this, that, whatever. And then he said, you guys are completely wrong. Come to IIT, come to my office in Powai, see what I'm doing. So we went there. It was like a most technology-driven office I've ever been to in that era. It had screens and monitors everywhere. It was like a network operating center. There were heat maps of where the demand is and where the demand and where they can guide the driver. It was still 99% phone-based booking. So I said, okay, this is all interesting, but it doesn't go from city to city. And then he said, you're just thinking the present. In those days, location-based services, LBS, had just come out because there was no smart data available. There was no data. So he said, all of this will change. And we said, he's the smartest person in the room. Let's back him.
Sure.
That's a case study of how, in my mind, you have to know enough to ask the right questions such that you can spot the smartest person in the room.
So there was a thesis and then you came across...
And the thesis was
Bhavish.
negative. Thesis was negative. We met every company in the space and we passed. And we met Ola and we were going to pass. And then we realized we were wrong. So the other big, very important, which is very unnatural for people, change your mind very quickly in this business.
Yeah.
Both positive or negative. What happens is people get into what is called the confirmatory bias. And they keep seeing new data in their own views.
Yeah.
That's why this business, why is there only one Warren Buffett in the world, right? That's why it's a little bit harder.
Let's take another case study because this is very interesting. I loved how you described the Ola journey. But let's take Onecard, for example. Did there again you have a thesis and then you...
It was a positive thesis. So I think Onecard, Anurag actually met here at an event, was introduced to me by Rajat and Vikram. Now here's the context, my context on Onecard. I had tracked Carlyle's journey with SBI cards. I knew SBI cards valuation on the day. I had previously, when I was in the US, tracked, in those days, Capital One, all of these were, that late 90s was when this industry was going up. And the fact that 1 million cards is equal to 1 billion valuation, I already knew before I had met. I didn't know that he was going to. The fact that credit cards have a very deep profit pool, I knew. The fact that credit cards in India are broken as a user experience, we all knew. So when we met him, we had positive thesis on the space. But the biggest question was, how are you going to differentiate and build it differently from everybody else, right? And that Anurag had been running this for 8-9 years. He was very clearly the smartest person in the room. And the smartest people in the room, it may sound counterintuitive, but founders should apply judgment and do this. I love it when people say, आप गलत सोच रहे हो. वही तो चाहिए, मेरे को खुद में तो नहीं बैक करना है. भविष्य तो अभी भी बोलता रहता है. Actually, अनुराग भी बोलता रहता है. I love it. That's actually very energizing for me. Yeah. Actually, Revant, like most of our top founders, Ashish of business, Revant of Mosaic, I love that line because then I know not only that the founder knows a lot, but they have thought through what I am thinking.
Sure.
And why that is wrong for their business. Chakri of Country Delight. I mean, so many times. So I think that's when I know this person is going to create a lot of value. Right. So Onecard journey, positive on the thesis.
Yeah.
Met him. This is our experienced founder, quote unquote, playbook. He had run ICICI's credit card business for 8 years. He has been through cycle. He's seen all of that because in financial services, you are a through cycle entrepreneur. Financial services cycles are coming. The question is every 2 years or every 5 years. Right?
And
RBI has just passed a regulation 7 days ago which changes the game.
Yeah. Yeah, so it's increased the risk margin for lending on credit cards and personal loans.
Correct.
Suddenly you need a lot of more capital. No, very interesting. And going in, then do you think, yaar, if we put this much money, to itna banega isme? Is that one of the...
करते हैं more for discipline, but it's never right. But let me just finish the thesis point.
Sure.
We actually believe, and there are 2 points I want to make. One comes from Jim Breyer of Excel, who says prepared mind. And there is this thing about luck, that luck is equal to preparation meeting opportunity. I think that's very important in our business, and I'll apply it to your context. So that's one piece of it. Second, like I said, change your mind quickly. This guy Fred Wilson of Union Square Ventures, who says strong views weakly held. The problem with consultants, a lot of people, even operators, is it is strong views strongly held. We want to be right. Not that we want the answer to be right.
Yeah.
We want to be right.
Yeah.
The answer is often right by you being wrong and you figuring everything else out around you.
Yeah.
Coming back to your, so wealth management, we thought we had missed. And we had a negative thesis on wealth management. And to Vikram and Rajat's credit, and I think we do this, different teams do it differently within Matrix, but I think we do it reasonably well. We hold ourselves to a very high bar on where were we wrong and why.
Which is like the anti-portfolio.
Anti-portfolio, but anti-thesis also. And sometimes we have anti-portfolio because we thought it was anti, then it went under, then we feel good. Ki ye to call theek thi. Because ultimately you're just trying to reprogram your judgment and your neural networks, right? So in the case of Deserve, we had reached the conclusion that we were wrong on wealth management. And if you remember, my guess is the discussions we were having would have been, what is your thin edge of the wedge? Now, in your case, it was easier because you start with an unfair advantage. So so ultimately, succeeding in startups is about harnessing unfair advantages to get off the ground. After that, you have to compete with everything else, right? So we thought we were wrong, and then you showed up. Not just showed up, Vikram knew you for a while and whatever. That was luck, right?
No, in fact, one of the things which I later found out is I ended up reading the thesis. And the fact that affluent folks need guidance on where to invest, when to invest. Right? We didn't articulate it that way, right? But that when we read it, it seemed clear as day. So in that sense, that thesis was there.
And then connecting back to your earlier point on trends, and I know at some point it'll come to my personal investing, then you have to back up and say, what are the trends in the market? Affluence is going up. People have less time. India's savings percentage into equities was only 2.5%. Now it's gone to 5%. SIPs are hitting, abhi to it's very clear. 3 years ago, when you started 2 years ago, these were the beginnings of the trends. Right? All these trends are playing out. Even fixed investing, fixed income investing is broken. People are leaving money in the bank accounts, don't even know how to do FDs. Then forget the bond market. So these trends were becoming clear. Then you go and pattern match this globally and say what happened in other countries when this same stage of economic growth was happening. More importantly, when this same stage of GDP per capita was happening. And it's obvious this will all play out. Right? Then it's a question of right to play, right to win, all of that comes in.
Yeah. No, makes sense. And I think a lot of investors have that view where you look 10 years ahead, right? And it's not easy. Like sitting here, we can debate that wealth mein to paisa banna hi hai and people are going to get wealthier. But there are so many things along the way that might come and like sort of hurt that journey.
But that I believe that the best founders live unconstrained journeys. So one of my definitions of founders' mindset is, lot of people, you give them resources and you give them goals. They try to meet them. Founders have goals, they generate resources.
Right.
I'll tell you one potential pitfall of looking 10 years forward is that you only think pitfalls. I think the best founders think 10 years out and then backwards. Saying this has to be done. Which is what I think. I believe some people will miss what's going to happen with India because it's very hard to imagine. But will there be aero taxis, robo taxis India just gave permission to a aero taxi service 7 days ago or 10 days ago. A year ago, you would say, how is that possible in India? Today, if I tell you that there will be drone-based deliveries in India, you will say, not possible, look at this, that, whatever. Or if we say there will be autonomous cars, we'll say, not possible, look at the traffic. 100% will be there. Could there be separate lanes from them? Could there be new technology that comes out? So I think future backwards in every way is very hard to.
And then the concept of leapfrogging, because for India, a lot of the stuff, like especially in the rails and financial services that we see, do not exist in other countries, right? And the reason they don't exist because the markets are already large.
I think it's a great point. It's a great point. We are able to leapfrog. Also, our digital infrastructure is the best in the world.
Absolutely.
We always used to worry that our infrastructure is broken, this, that, whatever. Our soft infrastructure is literally the best in the world.
Yeah. The now quantify for me, Avnish, and I know this is a hard one. When do you call an outcome a successful one? Let's say you invested going into seed and Series A, say $10 million into a company. When do you say that outcome was successful in purely number terms for Matrix?
Number terms, I would say modest is 3x, winner is 10x plus, and okay is 5 to 10. But it's never worked out like that. I think it's either modest or outlier. So it's either 20 to 100x. We made 100x almost twice. No. I think we have made 100x. We are in the money on 70, 80x once and 50, 60x. And this 20 to 80, 90x, we have maybe 5, 6, 7, 8 companies if I count the ones that are underway also. And then there is the 3x or less. Very seldom it's in this. And that's the nature of a business. It's a power law business.
And do most VCs think about this in this way?
No, because you can't plan for that. So even we don't think about it like that. But I'll tell you, most VCs results are still the same. So if you look at the most successful funds in the world, one company has accounted for 80% of the returns in, let's say, 50, 60% of the cases. Two companies have accounted for 80 to 90% of the returns in the next 30, 40%. So by that time, even if you look at our funds, it's generally driven so far by one fund. With a fund you are in, we are very excited because right now it looks like 10 companies. If that happens, it will be probably India's best fund, but who knows? I don't think it always plays out like that. But our fund 2 is 4 companies.
Right. Got it.
The rest are important. They contribute, but they are in the 3x, 4x. They are not, your outlier returns.
And therefore, I think, I guess what you're saying is either the companies are not successful at all, modestly successful, or then super successful. That
Correct.
Middle range of 7,
In
8x.
our kind of business, in private equity, that middle range is very important to juice their returns because they are planning for the 3 to 5x. So the 5 to 10x can really juice their returns and the check sizes are large. For us, that really happens. You had asked me this earlier. Do we plan for it at entry? Yes, we do exit modeling. Our exit model showed $125 million valuation for Ola. It's today $7 billion. Our exit model showed 250 million, I think, in the base case for something like a Country Delight. So already $1 billion will probably be a multi-billion. Onecard, I was always very optimistic, and Anurag will shoot me that this can always be 8 to 10 billion. So now, that doesn't determine whether we invest in the company. It determines how we allocate capital subsequently to the company.
Sure.
Right? And by that time, we have more data.
Sure.
And typically, 18 to 36 months into a company's life, you kind of know where it is heading.
So just to explain this more, this is where you are putting in more capital into the subsequent rounds that the company is raising, and that is guided by this exit modeling decision.
No, I'm saying exit modeling we will do at entry, but that will not, at a few tens of million valuation, that's not going to, if we think the exit of that company is 50, 60, we won't even invest.
Sure.
So the assumption is we are interested because it's a few $100 million minimum exit, right? So that's the exit model at entry. We do it to keep ourselves disciplined. But what really happens is we start looking at it, and it also helps us think what we call NBR, next round backwards, NRB, next round backwards, where we say, what is the scale of this company and how much, would it be valued at that stage? Therefore, what is the price we can pay today if we want a 3x, for example, right?
Yeah.
Where exit is very important is when you're doing the subsequent rounds, how much capital you're putting in and all of that, how is that view now tracking versus the view at entry? And generally we have found, and for various reasons, companies that are tracking at or ahead of plan end up then becoming outliers. And that's because it tells us, I think, and this is no science, but I just think founder and market and everything are getting aligned. Like stars are getting aligned and founder is riding on the back of that.
Sure.
But we give up to my own read 18 to 24 months, but I think it can take up to 36 months. But in that window, you kind of know. Very, very few. There will be exceptions, but that will be less than 5% of the ones that do well. That will blossom after 36 months.
And in a sense, therefore, you are reassessing that investment at every periodic interval.
But we have to, in fact, what we say, the team, also the mantra is investment thesis ends at investment. After that, you're again looking for the unknowns. And what we say for the next round is not how much the knowns have played out better or better than expected. How have the unknowns played out?
And I guess how the company has reacted to that also.
Yeah. I mean, you look at 5-star, you know the company well.
Yeah.
Every possible crisis that could happen has happened with that company. So when that company was going public, if I could, I would have bought $50 million of that stock. Because I've seen the founder through Demon, Island FS, COVID, some local politics in Tamil Nadu, every possible crisis. RBI norms changing every year to 2 years. And the company has only done better and better. It is compounding. I think it is a big compounder. There are many in the portfolio like this, but that's an example.
Yeah, and we were big buyers in the pre-IPO time, as deserved. This is quite clear. Now, let's zoom out for a moment and say that let's assume you're LPs. Now, a lot of Indian families, high net worth individuals are investing into funds. What should their framework be of identifying funds in this early stage category? Like assuming that they would want to create a portfolio and not
Are they
back
looking
only
at a
one.
new fund or a fund with track record?
Let's say a fund with track record.
So that's easy.
Yeah.
Number one will be track record. But what people miss is very few, people don't realize how little persistence of performance exists in this business. It's very low. One would think reputation, everything I told you, it's hard for new funds to start all of that. But the reality is there's strategy drift. There's people turnover. The people who got the firm to a certain stage are no longer as involved. So what would I look for? I would look at track record. But what I want to see if I'm making a new investment, because track record is not going to come to me, is what is their strategy, what is their continued right to win?
Even as a fund, you're thinking about that.
What is their right to win? Why have we built a team of domain experts? That's our right to win. And we are compounding now, thanks to founders like you, where new founders tell existing founders tell potential new founders, this is a good firm to partner with. And we are happy to do that with the other top tier firms and partner together, right? So I would ask that. What is your edge? Why would a founder take your money? That's my number one question.
Yeah.
And because see, increasingly, this is not a business where you're picking founders. The best founders are picking you. Because there's so much opportunity that there's so many good founders here now. Why will the founder pick you? How will you get to the founder early? And then how will they pick you? If you see our password, internally it's C deals first and externally it's founders first.
Yeah.
Those are the two models, right? So that's then specific to sector focused funds, because I don't even believe a generalist fund has a shot, if you ask me. Maybe at a very subs level. Then the second question is sector expertise. So together, they know SaaS better. They have a right to play, they have a right to win, they can help the companies, they can potentially merge companies with each other, very clear, right? They have a right to play and right to win. There are other funds in India that have done a decent job.
So you feel like track record is almost like a filtering criteria. And after that, you're trying to figure out what is the right to win for the fund.
Yeah.
Why would a founder take money from this particular fund as opposed to the many that are out there? And if you are able to answer that question, you should invest in that.
Yes. And what is the biggest disclaimer in all financial services projections?
Past performer is no indicator of future performance. Yeah, I think
But it's so true.
Yeah.
And people really make that mistake.
Yeah. I think even funds from the same house with different vintages get things right and wrong. Like some vintages are inherently...
It will generally be traced back to if they always had a right to play and right to win, it'll generally be traced back to team turnover or change in strategy. So a lot of times what got you from A to B, people change to try to get to B, from B to C.
Sure.
One big example is increasing check sizes. You don't know how to play that space, but you end up in that space.
Sure.
So I think in India VC also we have seen this a lot. In my view, the market is capped at a 750 venture fund. If you raise more than that, you will not win.
Yeah. So funds which become too large, therefore,
Yeah.
find it hard to deploy capital.
Yeah.
Got
Or
it.
they will deploy it, but in the wrong places.
Yeah.
Right.
Yeah.
We have seen this, by the way, already. In the last 1 or 2 years, people are pricing deals higher than they should because they are not in this set and they're trying to break into the set. And they have adverse selection because sometimes we would have passed on, like all the so-called top VCs would have passed on something that somebody's doing.
Avnish, see, I mean, today you are in a position where you have a lot of companies which are in the pre-IPO stage, or in fact have also gone public, like 5-star. And therefore, I guess you end up interacting a lot with public market investors.
Yeah.
And when you do, you probably are able to look at patterns in how they think differently versus how a VC thinks differently, right? What are some of those differences which have been really stark to you, and say that this is a sort of a mechanism on how a private market investor thinks versus, and this is a clear contrast between the two?
Almost everything is a contrast. There's only 15-20% overlap, and I think they are better investors, public market investors. Now, I can argue maybe VCs can spot reward more. I will say we had a slide full of learnings of maybe 10 points. What is the number one? They are bottoms up, we are top down. So they don't care about sectors, trends. To them, everything changes all the time.
Sure.
So they are looking at, show me the company, then I will tell you whether it's good or not. If I ask them a sector, now of course, I think the best investors are bottoms up, less in public markets. The best VCs are thematic. So it's as stark as it comes. And when I talk to them, I sometimes feel that I'm just asking very idiotic questions because the framework is very different. And I think VCs and private market investors have a lot to learn from public market investors. Public market investors have some to learn, maybe being a little bit more top down. Like if I say India GDP is level pe jayegi, theek hai jayegi, but valuations bahut zyada hai. Right? That is ultimately you're in the business of making money.
Yeah,
right?
Sure.
So I would say that is a lot to learn from them. And honestly, second, profitability versus growth, around this varies by market. But return on capital employed, ROCE, big learning from them.
Yeah.
Huge learning from them. Where are we the same? We are the same in founders and management, really backing it. But again, I think they are black and white on corporate governance. I think private market guys sometimes take the gray area on corporate governance. They just don't want to touch it. Nahi karna hai.
Right.
There are enough fish to fry, right?
Correct.
Why is this difference there? And this is going up even more. In any public market investor, what basket of stocks do you think they are tracking?
They are tracking a set of investable stocks. In India, for example, that's about 200 to 300 stocks.
Yeah, and that is going up rapidly in terms of number, right? Yeah. Listed are 300, and depending on your strategy, listed are 3,000. So some are looking at. Yeah. So they have no FOMO.
Yeah.
The best investors don't have FOMO. Private market investors live in FOMO.
Because you can also get in later,
right?
Yeah.
Abhi chhoot gaya to baad mein le lenge. Right?
Which
baad mein chhoot gaya to dusri cheez
do.
le lenge. Right? So they don't feel compelled. And I think patience, that a lot of that stuff, what can they learn from us? I think top down. I think thinking bigger. I think what we can learn again from them is the quality of diligence. I mean, everything is outside in. Vendors, go and find out, like smell out the issues in the company.
Sure.
Right? So what I think is the founder, the promoter partnership. I think private market investors do much better.
Much better. Okay.
And to the extent public markets could do that, I think they would enjoy it, but that's not their business model. They want to stay objective.
Yeah. One of the things which has stood out to me is how public market investors deal with what I call narrative violation.
Yeah.
Like as a promoter of a company, if I have articulated a certain game plan and I'm not sticking to it, that for them would be a cause to sell.
Yeah.
because it's not fitting into the thesis in which they invested. Whereas in
Yeah.
private investors,
Yeah.
they are seeing that as a nimbleness of the founder to adapt to different situations, right?
Yeah. That and I think and that's correct. And I also think it's the best self-correcting and disciplining force out there. I would never want to run a public market company. I think it's too hard. But I think every founder should. That's why I chose a different path so I can get away with it. It's the best reality check and self-disciplining that is out there. And it's how the markets are built, right?
Yeah.
There's a reason why there's a VC, there's a later stage. Ultimately, it's public markets. Right?
Yeah. No, very cool. Avnish, I'm now coming to a personal discussion around how you manage your money. And before that, like today, if you were to have $100 of investment surplus, how much of that was created in the Matrix journey and how much of that was created courtesy of the Baazee exit?
80-90% Baazee.
Even today? Wow.
Whereas the VC industry paid off yet. It's starting to pay off.
Right. Got it. So how do you then invest?
So I got lucky. I bought in Bandra real estate at 4,000 rupees. What do you think? Today, Kandivali is 50,000 or something like that, right? So I caught 2 or 3 cycles of 3x in real estate in India. Real estate has always fascinated me. I had one first principles of real estate correctly in my head from the beginning, which is rental yield is greater than interest rate, only then buy, otherwise sell. I just applied that 3 times consistently. Right?
You got 3 times opportunity to be able to do that.
So 2003, bought, sold in 2006 or 5, then bought, sold in 10, and then bought, sold in 14, and that's it. After that, market didn't move. Now, latest one, I don't care. I'm just looking at it as more personal thing. Right. So 3 times on that and equity markets. Both I started early. Also, I was not shy of leverage. So I was backing myself. And I used to always say only equities and serious debt for real estate because it's asset backed. Right? Sure. But it was just instinctive to me.
I'll just explain that. Yeah. I'm assuming you mean that when you bought real estate, you took a loan for that, whereas on the equity side, that was funded from your own capital. You didn't borrow to invest.
Correct. No margin trading and all that because I lost my entire net worth in the .com bust in the US because of margin. So I'd learned that lesson. So, but I always bought beyond my means because I said I will take debt. And Indian interest rates had started to moderate. They weren't crazy anymore. Yeah. One could see, and again, being a believer in India. So I was way overweight real estate, maybe up to 60-70% of my net worth. Then at the right time, I started kind of dialing it down because I've always believed equities is the right answer. Never in fixed income, zero in fixed income, even now. So I knew my future net worth is all going to be in equities, but in the riskiest asset class, which was private equities and in technology. So I knew most of my future net worth will be this. So I didn't want most of my present net worth to be that. Right? So real estate seems real. And again, got lucky with the timing of the market. Equities also. I have at different stages sold equities to pay off debt because I never wanted to screw up cash flow. And there have been instances, there have been again many crises along the way, right? And I wanted to keep investing in our own funds. Future net worth 10 years out, this will be 70-80%.
Yeah. And just on that particular point, as a VC investor, you have to put money back into your own fund, right? And that's probably a significant drain on the cash flow in any case.
I think it's the best investment. It's my best IRR is my own investments. And by the way, people think VCs make fees. I have been negative cash flow in this business out of the 17 years, probably for 15 or 16. And it's by design. I want to be negative cash flow. I never want to live off the fees. So what does that mean? Whatever, it's generally 2 to 3 times of whatever fees may be coming to me personally that are going back into the fund. And so a lot of the original piece of that was the Baazee equity also. Yeah, it went into the fund.
Amazing. No, this has been super clear. Great, Avnish, having you on the podcast. It's been a long time coming. Thank you so much for the time.
Super. I think we have spent quite a bit of time on this and it didn't feel like that. So well done. It just flowed and really enjoyed it. Thank you,
Thank you
Sandeep.
so much.
Cheers.